We stack sats and fat bags like massive backpacks. Relax and that's that, it has to be. A couple racks, flip that, in fact, smash and grab, attack, hurt the bulls, he's back. As for me, I never left.
Hey guys, what is up? Nate Pumpy Pump. Today I want to hit you up with some psychology of investing knowledge. I took a class when I was working on my finance MBA certificate in the art of investing. Now, it wasn't called the art of investing. It was just called like investing, I think. In the course, I would say that the single most valuable thing that has actually tangibly helped me in the real world as a investor, speculator, I don't care what adjective you want to use, is this book right here. And I don't know how well you can see it. Let me get out my thing. Yeah. The Psychology of Investing, 6th edition, John R. Nofsinger. I believe is Washington State University where I got my MBA. He's a professor from there. So I really recommend that you get this resource. Personally, it's made me a lot of money. But I'm going to go into a little bit of the content of this book today. And I have brought it up here on my Kindle. Hey guys, before we get into the content today, if you enjoy what you're seeing, please like, subscribe, and if you know other people are going to get value from this, share the video with them as well. Remember, this is not financial advice. It's intended to be educational, and I'm trying to provide some analysis to help you guys out in the markets in making good decisions. So, getting into the content here, the book starts in chapter 2, discussing the topic of overconfidence and how that affects investor decisions. And I'm just going to say personally, for me, this is a big one. It's really easy when you've made a lot of money in crypto to fall prey to this and to think that you just can't lose. It's us to misinterpret the accuracy of our information and overestimate our skill in analyzing it. It occurs after we experience some success. So yeah, if you've made some money in crypto, it's really easy to get overconfident. The self-attribution bias leads people to believe that successes are attributed to skill, while failure is caused by bad luck. After some success in the market, investors may exhibit overconfident behavior. After examining over 40,000 quarterly earnings predictions, they found that success leads to overconfidence. Analysts who perform well for a few quarters follow with predictions that are different from other analysts' estimates, and ultimately they have greater errors. So that's the important thing to get here. They had a huge data set. They determined from that very large data set of these 40,000 quarterly reports that successful analysts start making mistakes. I think it's like, if you're the lead car in a race, it's easier to make one mistake and then somebody catches up to you and you get overconfident. You start to think you can't lose. It's the hot hand fallacy. Overconfidence can lead investors to poor trading decisions, which often manifest themselves as excessive trading, risk-taking, and ultimately portfolio losses. Their overconfidence increases the amount they trade because it causes them to be too certain about their opinions. Investors' opinions are derived from their beliefs regarding the accuracy of the information they have obtained and their ability to interpret it. Overconfident investors believe more strongly in their own valuation of a stock and concern themselves less about the beliefs of others. So, talking to myself here. And guys, I want to talk really quick about the purpose of this channel. A big part of this channel is not so I can sit here and tell everybody I have an MBA and how not to screw up. Actually, quite the opposite. I fully intend to share, as painful as it's going to be, the mistakes I make, because what kind of education am I providing to anybody if I don't show you how to screw up? I think we learn a lot more from screw-ups than we do from successes sometimes. And it's important that if I want to help people come up, I want to show them how to also make mistakes and potentially help you guys avoid some losses. So don't worry, This week I'm going to be talking about social sentiment, hopefully some derivatives information, exchanges and on-chain flows, my NFT buying experience where, I accidentally burned some money there. I'll update you guys on my positions on Ledger X. I'm going to talk a lot about why Bitcoiners love green energy. I may not be speaking for all Bitcoiners, but I will speak for myself. As you see today, we're going to get started with these investing fallacies in psychology. And I'm going to also tell you guys a little bit about my experience as a cancer survivor and a little bit about how Bitcoin really has impacted my life and helped out my family, and really got us to where we are right now. Some of the stuff I'm working on, like personal projects, this right here is my GPU miner, and I have 6 GPUs for it that we'll be working on, and I will document getting this guy up and running once again. I have ran it in the past, but the motherboard did die on me, and I have to get that repaired. Over here, you might be able to see some of the ASICs I have. I have some S9 amp miners, 3 of them over here, and I got 2 more in another room. You can see some of the neon signs. We got Bitcoin, Chainlink, and here's going to the moon. Psychologists have found that men are more overconfident than women in tasks perceived to fall into the masculine domain, such as managing finances. Men generally are more overconfident about their ability to make investment decisions than are women. Therefore, male investors trade more frequently than female investors do. 2 financial economists examined the trading behavior of nearly 38,000 households of a large discount brokerage firm between 1991 and 1997. They examined the level of trading in brokerage accounts owned by single and married men and women. A common measure for the level of trading is called turnover. Turnover is the percentage of stocks in the portfolio that change during the year. For example, a 50% turnover during a year is the equivalent to an investor selling half the stocks in a portfolio during that year and purchasing new stocks. Similarly, a 200% turnover is equivalent to an investor selling all the stocks in the portfolio to purchase others, then selling those stocks to purchase a third set during 1 year's time. The study shows that single men trade the most. As illustrated in figure 2.1, single men trade at a rate equivalent to an 85% annual turnover. This compares with an annual turnover of 73% for married men, and then married and single women trade only the equivalent of 53% and 51% in annual turnover respectively. Note that this is consistent with overconfidence. That is, male investors are more overconfident than female investors, leading to higher levels of trading. On the other hand, it is possible that men are not overconfident, but rather that they might be better informed. If you truly have better information, trading based on that information should lead to achieving higher returns. So I think this brings up a lot of interesting information. I'm going to bring up the picture here. So guys, what we're seeing here is, going back to the mathematics study. The survey went something like this. They asked a lot of students in Western countries, primarily the United States, I believe was what was highlighted in this study. And then they asked students in like Singapore and China, and they basically said, well, how confident are you in your mathematical abilities? How good are you at math? And I think as most of us would expect, based on our commonsensical knowledge, cultural knowledge, Americans were, of the whole world, like the most likely group to say they were really good at math. And of course, male students, more so. And where you saw a big lack of confidence was typically among the students from these East Asian countries and South Asian countries like Singapore, I think, and Hong Kong. Well, they all had the same result where students always said that they were not confident in their math abilities. They did not think they were very good at math, yet their scores were much higher. So it's like a divergence, right, in between expectations and actual results. And so that really illustrates, I think, the overconfidence fallacy in action in mathematics as well, mathematics education for high school students around the world. I wish I had the exact study in front of me. You just have to take my word on it. In general, overconfident investors trade more. But is higher turnover and increased trading bad? Well, Barber and Odeen also explore this issue. In a sample of 78,000 household accounts during this 6-year period, they examined the relationship between turnover and portfolio returns. Consider an investor who receives accurate information and is highly capable of interpreting it. The investor's high frequency of trading should result in high returns due to the individual's skill and the quality of the information. In fact, these returns should be high enough to beat a simple buy and hold strategy while covering the costs of trading. On the other hand, if the investor does not have superior ability, but rather is suffering from a dose of overconfidence, then the high frequency of turnover will not result in portfolio returns large enough to beat the buy and hold strategy and cover costs. So they determined the level of trading for the investors in their sample, and they categorized them into 5 groups. They went all the way up to the 5th one, and what they found was that the high turnover rate group had an average annual turnover rate of more than 250% per year. Wow. So they were really trading a lot more. Kind of looks like the Pareto principle in action, right? Where you have this group between 4 and 5 there getting about 80% of the turnover being done by the biggest trading groups. The most frequently trading groups, I should say. Figure 2.2 reports the average annual return for each of the 5 groups. Note that all 5 groups earn the same 18.7% annually in gross returns. Therefore, high turnover investors did not realize higher returns for their additional efforts. However, commissions must be paid for buying and selling stocks Coinbase. This has a greater effect on the investors who trade more frequently, as illustrated in the figure. Net returns, that's returns after commission costs, to the investor are much lower for the high turnover group. The net returns for the lowest turnover group average 18.5% per year versus 11.4% for the highest turnover group. So the net difference of 7% per year between the highest and lowest turnover groups is dramatic. For example, if the investors in the lowest turnover group invest $10,000 over 5 years, earning 18.5% per year, they will have $23,366. They're just giving us the numbers, right? Overconfidence-based trading is hazardous when it comes to accumulating wealth. High commission costs are not the only problem caused by excessive trading. It has been observed that overconfidence leads to trading too frequently, as well as to purchasing the wrong stocks, wrong cryptos, wrong assets. Barber and Odin limited their analysis to a sample of brokerage accounts that had complete liquidations of a stock, followed by the purchase of a different stock within 3 weeks. Then they followed the performance of the stocks sold and purchased over the subsequent 4 months and 1 year. They wanted to determine whether selling stock A and purchasing stock B typically was a good decision. Apparently not. The stocks that investors sold earned 2.6% during the following 4 months, whereas the replacement stocks earned only 0.11%. In the year following the trades, stocks that had been sold outperformed stocks purchased by 5.8%. Not only does overconfidence cause you to trade too much and burn money on commissions, it can also cause you to sell a good performing stock in order to purchase a poor one. So then they get into the criticism of the study, because it's assuming that high volume means overconfident. So this other study examines that, and they asked questions to try to figure out how much overconfidence people actually had. Like, what percentage of the customers in your brokerage have better skills than you in identifying stocks with above average return prospects? And what did they get? Because the authors had the investors' past portfolio positions and trading records, they could assess whether investors really were better skilled. And interestingly, they found no correlation between investors' answers and historical differences in performance. They found, however, that this better than average measure of overconfidence is positively related to trading volume. Overconfident investors did trade more. So, yeah, they pretty much proved it. Overconfidence in the market. If many investors are overconfident at the same time, then signs reflecting such a trend might be found within the stock market. While the excessive trading of overconfident investors has been identified through brokerage accounts, does this behavior show up in the aggregate market? Several researchers believe that it does. Specifically, after the overall stock market increases, many investors may attribute their success to their own skill and become overconfident. This will lead to greater trading by a large group of investors and may impact overall trading volume on the stock exchanges. Examining monthly stock market returns and trading volume over 40 years shows that higher volume does follow months with high returns. For example, a relatively high return of 7% 1 month is associated with higher trading during the following 6 months. The extra trading represents 7 months of normal trading squeezed into 6 months. Alternatively, overall trading is lower after market declines. Investors appear to attribute the success of a good month to their own skill, and they begin trading more. Poor performance makes them less overconfident, and is followed by lower trading activity. This may be why the old Wall Street adage warns investors not to confuse brains with a bull market. Everybody looks like a genius in a bull market. All right, guys. Clearly, I'm winded. Well, guys, that's it for today. I want to thank you for joining us on this episode. I really hope that it helped you to get a grasp on some of the potential pitfalls you can fall into as a Bitcoin and cryptocurrency, crypto asset investor in this space, in this world. So if you like the content, please hit the like button, subscribe, share it with somebody else. Catch you guys in the next one. Take it easy. Bye.
Pumpy pump. Jesus Christ.